Hey, what's up everyone, and welcome to the School of Personal Finance. So there is one question that I've been getting over and over the last few weeks, and it basically goes like this. I've been losing a ton of money in my account over the last month. Should I move it over into a safer investment until the dust settles, until we see what's going on? I don't want to lose any more money. So in this video, I'm going to attempt to answer this question. I'm actually going to show you the specific comment that I got on one of my videos because I thought that he hit on a lot of good points in this comment. So I'm going to break it down and go through it and give you my opinion on it. Now, of course, none of this is personal financial advice. I don't know anything about you or your situation. And also, everybody has opinions when it comes to this stuff. So you never want to listen to somebody on YouTube and take them at gospel, because nobody knows, no matter what they're telling you, nobody knows where the market is going at any given point. So I'm going to do my best to answer all these questions, to share my thoughts about how I deal with this process, and hopefully just help you make the best informed decision that you can for your own situation. All right, let's get to it. All right, so a few quick things before we start. The first one is follow me on LinkedIn. I'm posting daily over there and I'm really enjoying the platform. The second thing is get on my email list over at schoolofpersonalfinance.com. Download the free PDF, 15 numbers that you should be tracking to become great with money. And then the third thing is check out my education center. So I'm building out a process where you'll be able to go in, take courses to create your own financial plan where I walk you through the process. And I'm also creating many courses that are in there. I'm in the process of doing one on investing in real estate. I created a course on the different types of accounts that are available, like 401ks, Roth IRAs, and how to choose the best one for you. I'm building out a student learning center, personal finance for students, high school students, college students. So big things going on over there. And for a limited time, I'm only charging $97 as I build out the content for lifetime access. So go check it out and enroll today. All right, so let's start out by reading this comment that I got on one of my videos, because I think it really does a great job of just summing everybody's fears up right now. So the question is, Rich, I cannot get a straight answer from anyone on this subject. If I take my balance of my money and put it into a stable income fund or a short-term bond fund, will that protect my money from disappearing and not lose my buying power when the stock market is down like it is now? I will continue to put money into my future contributions, diversified in stocks, etc. My balance just went down $50,000. Wouldn't I have been better off putting my $500,000 account value into the safer account option? What would be the pros and cons of doing that? Thank you for your time and really enjoy listening to you. All right, so let's break this down. So the first question is, if I put my money into a stable value fund or a short-term bond fund, will that prevent me from having my money disappear? So the answer is it depends. So with a stable value fund, the way that they typically work, and you have to look at the fund that's available inside your 401k and read the fine print, but typically they're like a savings account. So they might have an interest rate. Sometimes the rates are even better than savings account. So you could have an interest rate of like 2% right now in the stable value fund, and it doesn't fluctuate. So you can't lose money in those stable value funds. So that could be a great place to go for safety. Now, 2%, I mean, we could make the argument that it's good or it's bad or whatever. In this environment, it seems pretty attractive because stocks are getting pummeled right now. But if you've been in that stable value fund for the last 10 years, then you've missed out tremendously on all the growth that's happened over this last decade. But yes, a stable value fund should be stable. You should not lose any money in there. It is a place to go for safety where your money will not go down in value. With a short-term bond fund, those will fluctuate. So they will fluctuate less than a long-term bond fund or than the stock market, but they could go down. So like year to date, short-term bond funds, they are down, could be like 3-4% depending on what types of bonds you have in that short-term bond fund. So you can still lose money in any bond fund depending on the interest rates and what bonds you hold inside of that fund. So there's definitely more risk to that than having it in a stable value fund, but it's much less risky than having it in the stock market, for example. All right, and then the second part of this is more of a statement where he says, and not lose my buying power by losing money when the stock market goes down, but I will continue to add to the account and invest in a diversified stock portfolio. So I am happy that you said that you'll continue to add to the market through your future contributions, which also makes me believe that you're going to be working longer, right? So as the market is going down and you're adding money to it, your dollar cost average averaging in. That's one of the great things about 401k plans. Every 2 weeks, you got your money going in, and now the stocks are basically down, whatever it is, 12%, 13%, tech companies, 24%, then at least you're buying at these lower levels. So that is a good thing. And then he says, my balance just went down by $50,000. Wouldn't I have been better off taking my $500,000 account and putting it into that safer investment? And yes, you would have been better off doing that. But hindsight is 2020, and there is no way for us ever to know what is going to happen in the market. The thing that makes investing in the stock market so hard is that it comes with risk. And anytime you're trying to earn a higher rate of return, the more risky it is. So when stocks are doing great and everybody's making money, people seem to forget about the downside risk that comes along with that. And when things turn for the worse and you start to see your account values go down, that is when you get a gut check and you start to realize wow, I'm losing money and I really don't have any control over this. And you start to get nervous and you want to run to safety. And another thing to keep in mind is that timing the market, it really is impossible. You might get lucky every once in a while and time something right, but it is very hard to time the market and to know where it's going to be going. So even if we take, for example, right now, if you were to go ahead and move to cash, you're doing that by thinking that the markets are going to go lower and you don't want to lose any more money. But what happens if you move your money out of the market into that stable value fund and then the markets turn around? They start to go up. A lot of times what happens is when people feel enough pain, and it's not just you, it is people in general. When you have enough pain and you make that decision to move and stop the pain and get out, that is the point when things turn around. When enough people run for the hills, that's what we usually call a capitulation event. So the best thing to do when you feel this way is to take a step back and try to put things into perspective and start asking yourself good questions. Questions like, how much longer is it until I need to start using this money? So now if you need to start using this money in the next couple of years, then I might make the argument that you might be too aggressive to begin with. Another strategy that I will throw out there is what's called the bucket strategy, where you look at the next few years that you're going to be needing that money and you keep a few years in cash. So say, for example, you said to yourself, you know what, in the next 3 years, I know that I need $50,000 out of this account. Then maybe that's the amount that you have in the stable value fund so that you could sleep well at night knowing that you have 3 years worth of withdrawals that is safe and secure. But if you're not touching this money for 7 years, 8 years, 10 years plus, and you're going to continue to contribute to it, then by just telling yourself that, it makes it easier to live with these downward moves, because these downward moves, they actually do present a good opportunity for you to add money at lower prices. And as you get closer to retirement, you start to take the risk off a little bit. You start to move a little bit more into that stable value fund and protect some of this money so it's there for you in the years that you're going to be withdrawing it. Now, it's easy for me to say and it's hard for you to do, but living through these down cycles and just contributing to the account and adding additional money, it usually plays out best in the long run. But I'm talking 10 plus years or so, and we never know what's going to happen in the future. We could have the next 10 years of a sideways market. We could look out into the future 10 years from now and stock prices be the same that they are today. They could even be lower. I'll never forget when I graduated college in the year 2000, 10 years later, stock prices were down than they were 10 years previous to that. So we call that the lost decade. So that could definitely happen, and you have to be prepared for that. Stocks don't just go up. But now that you're losing money and you feel this pain right now, is it a smart idea to run for the hills, to take your money and move it into the stable value fund? I would argue that it's not a good idea. So a couple things. You have to get the timing right on the initial move, right? So is now the right time to move the money out? And if the market continues to go down, then you'll say, yes, it was the right time. But what about moving back in? How do you determine when you're going to go ahead and put your money back in at risk to get additional growth? So what happens if you pull out now, the market drops 10% and you think that you're a genius, and then you stay there and then it starts to climb back up? You're going to constantly be questioning yourself, like, is now the right time to put it back in? And you might never go back in, right? And then 10 years from now, the markets, they could be tremendously higher than they are right now. So it's just very hard to time it on the way out. And then again, on the way in, you have to get it right twice. And it is very, very hard to do that. So in my opinion, you never want to go all in or all out at the same time, because you could very well be wrong. And then you're going to be kicking yourself all over the place. But that doesn't mean that you shouldn't make changes. Maybe your risk tolerance doesn't match with your asset allocation. Maybe you are taking too much risk right now. And if that is the case, then maybe you do start to peel a little bit out of this market and move it into that stable value fund so you can sleep better at night. You don't want to be losing sleep every night watching the market go down. And we could be in for much more pain than what we're currently in today, but nobody knows the answer to that. I mean, you listen to CNBC, they put the 10 smartest people in the world in the room together, and they all have a different opinion of where this market is going. So nobody really knows what is going to happen. But you also want to be able to sleep at night, and you want to make sure that you're making smart financial decisions and that you're able to retire in the future. So other things that come into play are things like, do you have a pension? Do you have other income in retirement? Or are you 100% betting on this pile of money to get you through in retirement for the next 30 years or so? A lot of things go into making these decisions. So I'll leave you with this and then we'll wrap this up. But I remember very vividly working in a bank in 2007, 2008, and 2009. And as we were going into the Great Recession, which was much worse than the environment that we're in today, at least from a stock market perspective at this point in time. Maybe we will get to that point, over the next 12 months or so, hopefully not. But when that was going on, I remember clients, customers of the bank coming in and just wanting that FDIC insurance. They were taking their investments out in leaps and bounds and moving it over into CDs, money market accounts, FDIC insured types of products. And even if they did it a little bit early, right? Even if they saved some money on the downside and they felt very good about it, if you look out just 5 years later, if they didn't get back into the market, then they missed out on upside in the market. Think about if they didn't get in 10 years later, 15 years later. There were people who were just so disgusted with the market and watched their portfolio go down by 40%, 50%, where they threw in the towel and they said, I'm done forever. I'm not investing in this stuff anymore. It's rigged. And the people that do that still have a long time horizon, they missed out on tremendous growth that we've had from that point on. So I do hear you. It's hard to stomach the pain and it sucks while we're going through it. But you have to take a step back and look at a long-term time horizon. All right, that's it for this one. I hope that you found that helpful. Please make sure to hit the like button if you enjoyed this video. Subscribe to the channel if you haven't done so already. Go check out schoolofpersonalfinance.com. I'll see you again in the next one. Thanks.